Good morning, everybody. How are you today? You look good? Feeling good, Monty. Ohio to you, ni hao to you, namaste to you. Salam, my good friend. Charts and sound okay. Wonderful. Oh, okay, good. Well, good to see you. My name is Wayne McDonell. I'm the Chief FX Market Strategist for TradersWay.com. TradersWay.com is an ECN that allows you to trade not just Forex, but let's say you wanted to trade oil. Got it. Let's say you want to trade gold. Got it. Say you wanted to trade the Nikkei or the FTSE or the DAX or the Dow or the S&P 500. Got it, got it, got it, got it. What if you like doing binary options for scalping or for hedging? Got that too. Cool, huh? Okay, so what currency pairs are on your mind this week? Remember, I'm here to help. My personal goal for doing these webinars at FX Street every day is pretty simple. I want to contribute to 1,000 pips profit or more to your trading. And I want you to feel that you got those 1,000 pips or more specifically from attending these events. I want you to know it. I want you to feel it. I want you to think it. I want you to shout it on high from the top of the mountain. So we got a question about some Kiwi. What else? What else is on your mind, guys? Johnny's got $1.30 on the euro odd, huh? Very interesting. Come on, guys. This is interactive, right? You want me to do a PowerPoint presentation, I can do that, but why don't we make this interactive? Yeah, I love that. Yeah, my pullback to support method. That's not my method. That's just called trading properly. That's the funny name for that strategy. So what John's talking about is in a trending market, what I teach is that you trade pullbacks. Yeah. That's just successful trading, Johnny. So I'm glad that you got it. You get it, you got it, you know it's good. My rhymes were right. You wish you could. Okay, so I don't know. You guys are so quiet. What's wrong with you? You got 3 broken fingers? You want me to just talk, huh? All right. Okay, pen on fire. Pivots and stuff. Like, how about, let's quantify this. I charge at least $250 an hour for my time. So I'm here for free for the next hour and a half, and I'll talk about anything you want me to talk about. I would jump all over that. I would jump all over that. Let me help, guys, but I want you to tell me how I can help. Okay, I can sit here all day talking about, the last trade and the next trade. That's easy. Oh, interesting. A good book for understanding fundamentals, macro and micro. Well, there's many different angles to attack that one. One is a book on economic indicators that I have, and it's called the Book of Economic Indicators. The author's last name is Bombhole. One of the worst last names ever, huh? So don't Google Bombhole. uh, but go to, you got to be careful, right? Go to Amazon.com, go under books, go under like economics, and look for, I think his name is Bernard Baumhol. Yes, Larry's got it, yeah. And that's the Book of Economic Indicators, and it'll tell you what the difference between, like yesterday, everyone kept talking about, oh, the GDP number. I'm like, the Fed doesn't even care about the GDP. Why would you care? What they care about is the PCE. And you're like, well, I don't understand the difference between ADP and GDP. Does anybody know the distinct difference between GDP and GNP? Gross domestic product versus gross national product? I'm sure they'll tell you. So anyways, you gotta know this stuff. So is that what you're looking for? No, I don't think that's quite what you're looking for, but you should get that book anyways, because if you don't understand, then you're just not on the clue train anyways, right? So I would start there, and then what sort of a macroeconomic view? Let's see. I would do some research on the bond market. So look for a book on, bonds and yield curve and international markets, and because really what we are bond traders, guys. If you get a job at a bank or at some sort of fund or money management organization, as a currency trader, they put you in the fixed income department. The bond book, huh? Okay. Does it cover yield curve as well? All right. Yeah, that sounds good. But like I never stopped learning either. So I'm 43 or something years old, and I'm in college. What am I studying? Fundamentals. Right? FX Street offers a course through a university. What is it? Essex. That could be a good start too. Okay. So like one of the things that I'm studying now is manipulating data from the Federal Reserve databases to study and understand the relationship between interest rates and how they change between various asset classes and derivatives globally. And that's what I'm studying at Harvard, which is, I think, a really fascinating subject. So anyways, that would be a start. Okay, so here we are. This is the beast. And the issue now is it has done what it's supposed to do. So once it's done what it's supposed to do, it makes it very difficult to predict what it's going to do next. So we're kind of just basically flopping around like a fish out of water waiting for next week. So that means you wouldn't trade it like a trend, would you? So if you don't trade it like a trend, what sort of strategy would you use? Oh, I noticed Richard's comment. Bond values rise, interest rates fall. Well, shoot. I guess I can drop out of Harvard now. I already knew that. Oh, wait, yeah. No, of course things get a little more complicated. Right, so we'd be doing like the pricing of derivative models in relation to, various interest rates around the world and their relationships, right? So um, you can take it even more complicated than bond value rise, interest rates fall. Does anyone understand why that happens? Oh, let me answer the last question. Yes, go back to the oscillators. Basically, if you've already achieved, and I was waiting for my drawing tool, I keep forgetting. These FX Street webinars, the whatever software they use messes up with my drawing tools. It happens every week. Now I'm just sitting here spinning. Shoot. It's very difficult when you can't draw, but yeah. So what we're looking at here is you can see that I've used the MT4 drawing tool, and we started with a double bottom, higher, low. That's called a 1, 2, 3 reversal pattern at weekly support. Buy goes up, makes a new high. Use the last resistance as new support. Buy comes up, makes a new higher high. Use the last resistance as support. Buy. Took overnight, but boom, finally took off. Hit the actual target. Okay. Came down, used the old resistance as support. Buy. Wimps out again on the second test of the target. So some might call that a higher high. You could play it that way, but because you're using pivot points, you should not treat it as a high, but treat it as a retest of the pivot profit zone, because it's not supposed to go any higher. That's why it's red. And then what does it do? 100% retracement. That's definitely a clue that you're not trading it as a trend anymore. So you would use these oscillators because you're trading it basically as a range-bound market. Now, does that mean you have to sell it up here? You definitely could if you're a bear. If you're not a bear, at least that would be your target if you're longing it off the support. Because all that matters here is support and resistance. Okay, so let's talk about the bond relationship. Why if bond prices rise, why do interest rates fall? And if bond prices fall, why do interest rates rise? Anybody wonder about that? Is that what you're studying at university? Well, it's not because of yield. That's what we're talking about. Bond yields rise and fall. And I can't draw with my drawing tool. How would I possibly do this now? I don't think, you know what? I don't think I can answer that question because I can't draw. Maybe I could try with this webinar software stuff. Let me try here. Yeah, but the market sets those, right? The market sets the prices. Let's go to a template. Let's see if I can use this webinar software to draw. Oh yeah, blank. All right, so let's see. What are we using here? You're sharing. Annotation. All right, we'll try to annotate our way through this. Okay, so we're going to have to draw a chart. I can't tell what color this is going to be. All right, well, I guess that's good enough. All right. So, yeah, what are we going to have here? Let's do money supply. Okay, this is the amount of money in the economy, because that's what the bond market does, right? We'll call this interest rates here. Okay. And so we'll talk about, let's say this is the money supply here. And like every good student, you should properly label your chart, right? So money supply 1. Okay, it's a vertical line because the money supply is the money supply. There's no slope to it. It is what it is. Okay? And then depending on what the interest rate is, and let's see if it'll let me change the color here. Okay. You have demand for this money. Oh, come on. Got like a fancy mouse, and sometimes it's difficult to use. Let's try it again. Okay, so this is now the demand for money, right? Money demand. So you have, right, a supply demand curve, right? Changing colors again, interest rates are now set by the equilibrium point of these two things. Okay? And that's what the interest rate would be. So the Fed does quantitative easing. What happens to interest rates? Interest rates fall. So let me draw that again. So now we got a new money supply. So the Fed comes out. Let's see if it'll let me draw. It doesn't feel like it's going to let me draw. No? Hello? Okay. So the Fed buys some bonds. Fed buys bonds, otherwise known as QE, right? Bonds. Okay, the Fed buys bonds. So they buy bonds and they give the bond dealers money. And the bond dealers put that money in their bank account. Okay? So the Fed gets bonds, the bond dealer gets money. Money now goes into their bank account, and then that enters the money supply. So money supply goes up, which means this curve, MS1, needs to shift to the right because money supply has increased, and the bottom of the chart shows the increase would go to the right. So now we got money supply 2. Money supply 2. Okay? And that means, let's go back to this burgundy color, I guess it is. That means if you follow the money demand curve down here, it has to go to the new equilibrium point. And you can see now the interest rate has fallen. So if the Fed buys $10 billion in bonds, how much does the money supply change? Well, for that, you're going to need an equation. The change in money supply is equal to, right, 1 over R plus E. So, right? So the change in money supply was 10 billion. It's equal to 1 over. Now, what's the required reserves that the Fed makes banks hold? What's the reserve requirement ratio in the United States? According to the fractional reserve banking system and the reserve requirement ratio set by the Board of Governors, not the FOMC, but the Board of Governors, the required reserve ratio in the United States is 10%. Excess reserves, that's for a complicated question down the road. We'll just set that at 0. Where did my annotations go? Awesome software. Where did it go? Did you guys just lose everything? I didn't even touch anything. I was drawing down here. I guess there's like a 2-minute maximum for annotations. Well, there you go. I guess someone's mind just blew up, right? So let me just answer the question, okay? The delta of the money supply is equal to 1 over R plus E. The delta of the money supply is equal to 10 billion equals 1 over R plus E. 10 billion equals 1 over 0.10 plus 0. 10 billion is equal to, you take the 0.10 plus 0, that's still 1.0, so 1 over 0.1 is 10. Therefore, 10 billion is equal to, right, is equal to the 10. Swap over the numerator and the denominator. So anyways, the answer is $100 billion. The change in money supply is equal to $10 billion when the Fed buys, the change in money supply is equal to $100 billion when the Fed buys $10 billion worth of bonds. Now, why does that happen? Why does the Fed buy $10 billion of bonds, but the money supply changes by $100 billion? Okay, so the Fed buys from Goldman Sachs. So you got Goldman Sachs. Okay? Their bank account goes up by 10 billion. Okay? 10% of that has to go to the Fed. 1 billion goes to the Fed. 9 billion gets loaned out. So Goldman Sachs loans out, or the Goldman Sachs' bank, let's say, loans out 9 billion to somebody, and that gets deposited at a Bank of America. Okay? So there goes up by 9 billion. Right? 900 million goes to the Fed. So we'll label this Fed. Right? 900 mil. So that gets deposited somewhere else, JP Morgan. Okay? So now we get 8.1 billion. Well, 10% of that goes to the Fed. You see what I'm doing? And then this goes down to Bank 2, or Bank 3, right? Some of that gets, and that goes to the Fed, and then Bank 4. And then 10% of that goes to the Fed, Bank 5. And they keep deposit, loan, deposit, loan, deposit, loan, deposit, loan. So there's this thing where people say the Fed just prints a bunch of money. Well, first of all, the Treasury has the printing press, not the Fed. And where the money comes from is the fractional reserve banking system. And the money is created through the fractional reserve banking system that says 90% can be loaned out, 10% is held on reserves. That's the reserve requirement ratio. So if you really want to make a dramatic change in the market, you could lower the reserve requirement ratio, and instead of 10 billion turning into 100 billion, it could turn into 120 billion. Just lower the reserve requirement ratio. So I think that's an interesting process of the fundamentals, because this is an important thing. Okay, so now you can imagine how this could affect the bond market. And interest rates move. But when an economy has falling interest rates because their central bank is buying bonds and increasing the money supply, then the value of the currency tends to fall. And it's all interrelated. Okay, you see? So the Fed buys bonds, money supply shifts to the right, right? The money demand slides down the curve. Bond prices are going up, interest rates are falling, but also the value of the currency for that economy. Well, John, imagine you're the Fed and you have $3 trillion worth of bonds on your balance sheet. And remember, they're loans. So it's a profitable business, John. Because remember, they get all that money back. Well, I don't know what the balance sheet is off the top of my head at the Fed, but just imagine it's trillions of dollars. They're bonds. Those countries and those banks and whoever, have to pay that back. And they're paying the Fed interest rates. Yes, the Fed is quasi-private. The shareholders of each individual Federal Reserve Bank. So there isn't a Fed bank. There's 12 individual central banks in the United States representing each region. So the member banks in each region, so like, let's say Bank of America and Wells Fargo are both San Francisco banks. They would be members of the Federal Reserve Bank of San Francisco. And Wells Fargo and Bank of America would be shareholders of the corporation. The member banks actually own shares in that private institution. It's a company. It's a corporation. It's not a government entity. The member banks elect, I think it's 6 directors, 3 from the local business community, 3 from I guess they'd be economists, and then the board of governors elect 3 officials also to sit on their board. Held accountable to Congress. Well, sure, but like, for example, if you're on the board of governors, each member of the board of governors sits on a 14-year rotating term, which means that they outlive. They sit on the board longer than any president will be around, so they're independent of any political pressure. But the President of the United States is one that nominates someone to be on the board of governors at the Federal Reserve Bank in Washington, D.C., but then they have to be confirmed by the Senate and the Congress as well. And only Congress can, allow the Fed have additional powers. So it's very interesting. And each must be from a different part of the district. That's correct. So you can't have the members of the Board of Governors all be from like New York and Chicago. Now every governor is from a different region of the United States. It's really a pretty cool system. All right, so we digress. All right, let's go through some charts, huh? Okay. I suppose I have to annotate again, right? All right, so let's take a look what's going on. Okay, there's an old zone. Price kicks, makes a drop, right? Here's the low, right? So on the retracement, what you do is you take the old support and should become resistance again. It came back a lot more, right? But whatever. Makes a new low, right? So what do? You use this as the potential short. It comes back, you short it, and then we're at end of day. And it just happens to be, a pivot for today. Cool. So that's yesterday's price action. Today, what would you probably do here? You probably shorted, right? So let's take a look at why. One, I would describe yesterday as more bearish than bullish. Okay? Just because we started here and the low was here. But also look where the close was. So I look at the high, the low, and you can see I have them marked, right? Yesterday's high, yesterday's low, okay? And then here's the close. So that's if you use the close, then that's a weighted average if you go high, low, close divided by 3, and you got a daily central pivot point based on that. And the daily central pivot point would likely to move down in that mathematical equation. So most likely you're a bear, not a bull. The ideal place to short when looking at this equation is somewhere between the 382 and the 618 Fibonacci retracement. Because your goal for the day would be that. Am I right so far as you're thinking? Okay. So the 382 to 618 Fibonacci retracement is here. So the ideal zone would be anywhere up there, ideally around the London Open. So I think if you tried to short sort of in this area here on the London Open, you did the right thing. If you put all that other stuff into your analysis, you did the right thing. Which means, it finally rolled over and you probably got short in here. And you felt golden all morning until you got knocked out at break even. And you said, gold, take it. But you did the right thing. It's not your fault. I know. It's not your fault. I know. It's not your fault. I know. It's not your fault. I know it's not your fault. I know it's not your fault. I know. How do you like them apples? Yeah, it happens. Okay, that's that. But like many things, we're kind of at the end of the week, early in the on Thursday where we're done. Um, yeah, well that happens. So now you got the $1 million question: are you a bull or are you a bear now? And that's not that easy to discern either, because you can change your time frame here. Instead of looking at it on a 15-minute chart, maybe on a 4-hour chart, it still kind of looks like this. Right? Well, see, it could be one or the other. That's why I don't want you swinging both ways like a broken gate, because if most amateur traders that do that are simply wrong both ways, not right both ways. So I'd rather you get knocked out in here and say, well, I'm going to find the next level of resistance to sell. I wonder if it'll come back to 110, question mark. That's what you should be doing. Instead of chasing price around like a dog chasing its tail, you should just say, well, I'm still a bear. Nothing fundamentally has changed. So I'm going to look at the next level of resistance and set up an ambush. Oh, 110 is probably good. And you're setting up your short, which may never happen, or it might happen 5 hours or 6 hours later. That's what you should be doing, right? So, like, for example, you're just going from swing to swing here. Okay. And you can see that someone's already tried the 618. Okay. Now, if I were to venture to guess here, I think we need a cooling off period. Okay, this drawing tool's out again. All right, good. I would be very careful in here. Come on, drawing tool. Hello. All right, finally. All right. I'm quite suspicious of this. Right. And I think we could just kind of get monkeyed around in here for a while. How do you feel? What do you think, guys? That's what it feels. It feels like an August, you know, it feels like an August sort of consolidation. Whoa, whoa, ho, ho, ho. Whoa, whoa, ho, ho, ho. The most beautiful trade in the world. All right. So I don't know. That's what my spidey senses are telling me. The 786 is the sign of weakness. So it better giddy up, I guess, is what I'm saying. Let me read. Let me move some of these things around. It better giddy up. If it's going to fall, which it might, okay, it kind of needs to continue this move, right? So therefore, at the very, let's say at the very least, we'll give it a little like 3-wave correction. To keep the Elliott wave dudes happy. And well, I'll make it a little simple, but kind of like that. And he says we already got, the lower high, lower low. Well, I think what you're suggesting is it could roll over now, which I don't disagree with whatsoever. Except it's Friday in the middle of summer, so I'm suspicious that we don't have the guts to do it. I'm anticipating everything taking longer than it should. I'm expecting mediocrity. So I think it will fall, but I think it'll take a lot longer than you would want. And you meaning me. Right? Not just you, but you meaning me. I think it's just going to take forever to do that. Like we basically, this little pattern that I drew, that's all of next week. And it doesn't move down until non-farm payrolls. And we get a good non-farm payrolls, and the whole world says, oh, the Fed's going to raise interest rates in September, like a bunch of monkeys, right? And whatever. And the dollar gets strong for a while. And then all of a sudden, as soon as we get to this bottom, people are going to say, oh, but what if the Fed doesn't raise interest rates in September? What if it's December? And it comes back. And, So I think it's going to take a long time to head down. Then it's going to wimp out at the double bottom, and then we'll just flap our lips until September 17th. Then we find out the Fed's not going to raise interest rates in September, and then, oh my God, the end of the world, so on and so forth. Sound like a cranky old man, don't I? Well, I'm thankful that you're on my team and that we could trade this together. Whoa, whoa, oh, oh, oh. Ba 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 ba. Yeah, looks like we're caught here, support and resistance as well. Warren won, and it'll be the December meeting. No, Pan, no. I'm too smart to get a PhD. So, no. Yeah. So, I don't know. It's one of these things where I just love learning. I just love learning. So one of the things in my new class that, of course, hasn't started yet, but I'm already doing the homework, is manipulating data right out of the Fed's database. I mean, how awesome is that? Now, to a lot of people, that sounds incredibly boring. I'm enthralled. I'm enthusiastic. I think it's awesome. So I don't know. So if anything, I'm just doing it for fun. Maybe I just like spending money. Yeah, that's a full life. What did I do yesterday? My son and I spent the afternoon at a food bank. Interesting life. There's a small chance I might sit on their board. I think I'm going to decline, though. But, cool stuff. Cool beans, man. So anyways, here's the pig dog, right? And I already kind of have it set up as a wedge as well, right? I mean, it's clear as mud again. Look how tight this is getting, really, if you want to look at it like this way. You know, it's getting tighter and tighter. So again, I think we're preparing for Europe to go to sleep, take its annual nap. Yeah, yeah, Ron, all of it is good, I think, right? My style of even coaching, but of parenting as well, which is similar in many ways, um, is not necessarily through talk. It's through action, right? What I call participaction. That's why I ask a lot of questions, and that's why I get upset when you guys don't respond because I'm trying to teach, and right? But so I can like tell my kids how to be good people. I can tell my kids how to be smart, interesting people that contribute to society, or we just do it. So, for example, we spend time at a food bank, and it's normal, and we go there and we talk about it, and we learn, and it's just it to them. I suppose it should be normal. Like, doesn't everybody do that? Now, why wouldn't you contribute to society? Right? It's no longer a discussion of why. It'd be a discussion of why not. Or, well, like when my kids are preparing to go to high school, I will be graduating from Harvard, and they're going to come to my graduation ceremony in Boston. And I don't have to say, you should study really hard in school so that you can go to a good university and get an education and be smart and well compensated for your contribution to GDP. But they've just seen dad studying all day and all night as young kids. They just for years would see daddy studying hard, working hard all day, studying hard all night, sometimes waking up in the middle of the night, or very often waking up in the middle of the night, right? And then all of a sudden, going to graduation and seeing the how awesome graduation at a university like Harvard is, and they would just assume in their mind that that's what they want too. They would just assume that that's what they're going to do too. And I don't have to tell them. I don't have to yell at them. They would just be the assumption. Like, why wouldn't you do that? You know what I mean? So that's a lot of the decision of why. Yeah, yeah, yeah. We were talking about that yesterday, about ordinary, extraordinary. That I try to teach my kids, and my wife and I were talking about it. Just that extraordinary in our household is considered ordinary, and that if you do something extraordinary, there's no real extra reward because you're only average. Because it's just ordinary. What else are you going to do? Anyways, I like to lead through action. I'm glad that we meet every day too, because it allows us to do that. It might take a little longer and it might take a little extra effort, but you come out of it learning. I mean, you actually know. Is anybody starting to see the light of day in their trading because of the stuff that we're doing? I know the market's been frustrating where if you don't take your 50 pip profit very often, you'll lose it. But I don't dictate the market conditions, right? But the thing is, are you starting to feel like at least you have control? Are you starting to feel like when you pull the trigger, the trade starts out good at the very least, right? When you pull the trigger, it looks good right off the bat. I remember there was a time 100 years ago when I'd pull the trigger, and as soon as I pulled the trigger, I'd say, "Oh, I shouldn't have done that." I'd wait like 3 or 4 hours for a trade. I'm waiting. Sometimes I'm sweating because I'm only 3 pips away, right? I'm only 3 pips away, 3 pips more, and I'll pull the trigger. Please, 3 more pips, 3 more pips. And finally it goes up there, and I'm like, boom. And then I'm like, oh, I shouldn't have done that. How confusing. Um, yeah, Rod's actually doing the 2020 OCL. I found that the same, actually. Even 25 25s, or even I've done 15 25s, where I'm not risking much at all, but I'm not asking for much. But it's the putt scenario that we talked about maybe last week, right? And that's a typical move for me in the summer. You want to do the CAD news? Sure. That's a typical move for me in the July, early August threshold, and I have talked about that with you guys in the past, where it's just putt, putt. I also call it shooting at rabbits. So, in the summer, I don't expect much as far as follow through, but we've had a really good summer so far, and I'm very thankful for that. It's been way better than other summers. But I don't have like a bunch of 300 pip winners either. But I would say 3 weeks from now, I will be changing my strategy from shooting at rabbits to setting up traps for big game. So I don't mind a bunch of, I don't want 15 pip winners, but 25 pip winners, sure. Should be able to knock those down. Right? Like, look, if your trade can't get 25 pips profit, it was a crappy trade to begin with. Let's just, face the facts. All right, so let's just change it. We had questions about Kiwi. You like Kiwi dollar or Kiwi yen? Mm-hmm. Yep, clear as mud, huh? You see how it changes as soon as we break through this level? All bets are off. By the way, how does a bear trade that on the break? You can see I have it set up with bullish price action, right? So I'm a bull, and I have it set like this. Now, of course, we drew all this before it happened, so you have to bear with me. But, I was clearly thinking that. And, I'm not that far off, right? I mean, that's not horrible. You can see I drew it well before it happened. And I'm not far off. I mean, I've done worse. Um, but it does turn bearish, doesn't it? Because it didn't bounce. So how do you trade? Because, someone actually did this, right? Double top, then through support. What's your next move as a bear? Sell the doji. You should be way ahead of the doji. Sell the role reversal. Yeah, hammock. Hammock. Do it, do it, do it. I mean, look, you had 4, 8, 12, 16 hours to prepare. I know only 16 hours, but it's like doji, right? It's like God complex. You like to trade the doji? I created the doji. All right. Anybody thinking the Canadian GDP is going to be ripper awesome? It's going to be a huge, awesome number. Whoa, whoa, oh, 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 whoa, oh, 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 boom, 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 boom. All right. Looks like our guess has failed. We're at the 786. We'll see. Richard, I don't remember. I think I was up like 43 pips. Right? And where I got knocked out, honestly, I don't remember. I was at the at the the at the food bank all afternoon, so I don't know where I got taken up. Yeah, well, apparently I would hope, right?
Employment cost 0.2% is 0.4 lower than expected with no back month revision. Canada GDP minus 0.2% month on month is 0.2 lower than expected. Year-over-year 0.5% is 0.3 lower than expected.
Chevron reporting revenue $40.4 billion, well above the $30 billion consensus. Headline earnings 30 cents a share, and likely comparable. Charlie Victor X-ray.
Thank you, TradeTheNews.com. Negative number. What do you think? Is a negative number good for GDP? No, a GDP number shouldn't be a negative number. What do you think? Is it a one-off? No, actually, it's the fifth month in a row. What? Fifth month in a row of negative numbers. Well, why do you think Canada's cutting interest rates? Because their economy is contracting. Oh, Ben asks about the matching stuff. Um, you know, I've seen many different ways of doing it. So just pay attention to um, the terms of the agreement. Okay. But really what it's for is, some people say they just can't trade a demo, it's not real money, blah, blah, blah. So, they have to have, so they put in real money, but they don't want to put in real money. I mean, really, you shouldn't need a promotion like that, but why not? Like if you only had $1,000, okay? But usually it's done through leverage, so you got to be careful. Okay. But, Trader's Way, as you probably are referencing, has a deal like that where you put in, let's say, $1,000 and they give you a $2,000 account. And I think they do it in a better way than a lot of other brokers that do something similar. But at the end of the day, I'm a trader, right? I'm their chief market strategist. I'm not a broker. All right. But The page to get that information is under promotions, 100% deposit. So the best thing is, when choosing a broker, find one that you trust. And if you're going to take advantage of a program like that, then read the facts and just make sure you understand what you're getting yourself into. Okay. Yeah. Hey, my pleasure, dude. Okay. Well, but see, John makes at the point, if you can't make money with your $100, don't, you probably can't make money with their, but doesn't in that lie its own unique problem? Is this really a market for those with $100? Like that's all the money in the world you have? This is really a sport of kings, isn't it? Yes, I'm sure they offer joint accounts, of course. This is really a sport of kings. This is where, multinational corporations, large hedge funds with billions of dollars, this is where they play. I would tell someone that only has like $100 or even $1,000. That's all the money in your world. Here's what my advice to you would be. Go through your house, find all the crap you don't need and sell it. Two, get a night job, work all day, and then get a second job. And I'm not joking. I seriously mean it. Work at night, work on the weekends, and take all that money and save it for your account. And you'll do this for the next, 2 years. While you're working two jobs, you'll also follow the market and trade on a demo account and take the advice that I give on how to educate yourself, because I'll make you a trader if you will bear with me long enough, because you have to go through the cycle of learning, not me. And after 2 years, you'll be a very, very skilled trader that is confident because you would have built really solid trading habits, and you'll have a reasonable chunk of change saved to start trading real money. Throwing down, if you only had a few $100 and that's a lot of money to you and you haven't traded for very long and you don't really know what you're doing, you're just going to be a liquidity event for somebody like me, that I will trade properly, you will trade improperly, I'll make money, you'll lose money. And that's how it works. It's a zero-sum game. I'll win virtually every time, and you'll lose virtually every time. So why don't we turn it around and say, you're going to build skills over the next 2 years, and you're going to make sacrifices for your future career. And you're going to take a second job, and you're going to save every penny. And 2 years from now, once you have developed skills and confidence, you'll be properly funded. Okay? So I traded on a demo account for 2 years. WWWD, what would Wayne do? Well, that's what I did. Okay, once again, a big move on the kitty cat, clear as mud. The U.S. news wasn't fantastic either. Let's go back to the Euro USD. Skills for bills, huh? Yep. So I'm really looking at the market for next week. As you can tell, I'm not really in it. Don't really care today. That's a pretty awful move, huh? What's going on? The cost index was a miss, but it's interesting. I don't think it's that big of a deal. You know, I think all this is, it's not a sign that the Fed's going to raise in September. That's all this is. So like the ECI, the Employment Cost Index, has gained 14 quarters in a row. Okay? So that's a good trend, right? But the world is asking, is the Fed going to raise interest rates in September or December? And this was, again, it's higher than last quarter, so it's now 15 months in a row, right? But it's not as good as they expected. Other words, it's not good enough to make the Fed raise interest rates. It's not that much inflation. But I've never thought it was September anyways. And you knew that 6 months ago from me, and you knew that 12 months ago from me. I think if you actually pay attention to the facts and stop, reading newspapers and watching TV programs, you find out that a lot of this is not surprising at all. I mean, it's surprising that it's a surprise. It's surprising that it's discussed. And it's surprising that it's debated. But if you actually look at the facts, you're like, it's clear. You know what I mean? Yeah, I mean, it's just, I don't know. So, I mean, obviously the Fed could raise interest rates in September, but according to what I read, there would be no reason to. So that's how I go into these things. Where are we in the process? Are you guys going to sell the top? Huh? Are you stinking about it? What's your entry? Is it going to be 80, 90, or 00? Oops. This is the end. Oh, I'll never trade the euro again. What do you think? Where's the mark? 80, 90, what? You're going to pull it 95? Pan's going to pull it on 00? Sell 111.50. Holy smokes, you're talking Monday, dude. You're going to take the R2? Yeah, those are a long ways away. Yeah, maybe we hit it, right? Desperately in need of some resistance. Yeah, well, some would say we're not going to hit it. Patience, grasshopper, patience. Well, we'll sit here. Maybe a good opportunity for a binary, huh? $68, $67, $68. Yeah. Wonder if it'll make it. Desperately in need of some trader's hand and a desperate land. Boom, boom. Cool. Binary Friday, that's funny, huh? You know what I was thinking of is doing like a summer school, like an education program through the entire month of August or something. Like start over again. What is money? What is money supply? What's a moving average? What's an oscillator? Price, time, support, resistance. It's almost like going to like a golf school, right? And they teach you how to line your ball up square, how to grip your club properly. What would you want to know about bonds? I mean, we don't. Well, see, if I'm going to do bonds, then I have to teach you like time value of money. And it gets some of it gets into a level of complexity that wouldn't necessarily, for a class like that, be immediately important. So yeah, euro dollar's already slowing down. Didn't even quite hit our resistance level. It was close, but it's funny how it's just not an awesome move one way or the other, is it? Even on the surprising part. What about Bitcoin? I don't know, cryptocurrencies and stuff. I guess it's just not my bag, baby. It's just not my expertise. It's just something that I didn't get into. But, yeah, maybe, but I don't trade that way either. Okay, I'm a global macroeconomist, is the way I look at my point of view to my trading. And when I pull the trigger, there's a reason. And to me, it's my alpha, my unfair advantage. It's my risk management tool is to be right most of the time. And to me, a currency isn't a currency isn't a currency isn't a currency, right? So I don't know. I'm sure you could just use pure technicals on it and stuff like that. But yeah, I don't know. So again, what I'm saying is I don't know. So I wouldn't want to teach it. It's like if you had to hire a pro to teach you how to play a sport, would you hire Jordan to teach basketball or golf or baseball? Your only choice is Michael Jordan. Well, he's pretty good at golf. Well, he had a chance there at baseball, but I'd pick basketball. You know what I mean? I'd pick basketball. Here's an interesting fact that I came across the other day. I looked this up. I don't know why. Michael Jordan has made like 23 triple doubles in his entire career. 23. But the guy that holds the record made like 250 or something like that in his career. I'm like, what? Yeah, I'm sure you could trade it, right? I'm just saying I haven't traded it. I'm not an expert. I don't have an unfair advantage, so I wouldn't want to teach you. Sure, you know what? I could create a course. Charge you how much? How much do people charge for courses now? Some guy was telling me the other day, met in a bar, and he's like, "Oh, I took a Forex class and paid." Who is it? Online Trading Academy or something like that. $10,000. Like, holy crap. Really? Holy crap. All right. So, all right. I'll charge you $1,000 on a course on how to trade Bitcoin. I might not be able to do it myself, but I can make a really nice course. Just doesn't sound right to me. Wow, people are really charging that kind of money, huh? $2,000 to $3,000. Holy crap! Interesting. Well, I'm looking for people that already can produce 300 or 400 pips a month. Tim Sykes, really? That's great. The penny stocks guy. Huh? I read his book. It's pretty funny. $14,000, huh? MTI 7,000. That's who we probably paid the 10,000 to. Amazing. Yeah. Well, can anyone produce 400 pips a month? Cool. Well, I have a program where I fund people with $100,000, but I need people that could already trade. So, send me an email. All right. I think I've taken up my time. FX Street, do we have more time? Moderator, are you still around? We have some more time? Okay, well, let's do another currency pair. Thank you, moderator. Yeah. Give me a pair, any pair. Well, thank you. I appreciate that, moderator. I really do. Thank you. Pick a currency pair, any currency pair, ladies and germs. Pound Kiwi, what? Marina only does the crosses. CAD yen. That would be an awkward one today. Pound Oz, Kiwi dollar. I think we did Kiwi dollar, didn't we, Denise? Ruble. Crude. All right, let's do crude. You guys are funny. Yeah. Oh, I'm sure you do. All right, so oil, huh? All right, so I'm wondering if this is the best chart or not. Our actual bottom's 44. Zone of buying dips now. So it could go down as low as 40, but we're kind of in the zone. I have this drawn on a different chart. Let's get rid of pivots. This is the end. Do do do. Wow, pivots are still there. Did I miss them? Why are the pivots still there? Bum, bum, bump, bum, bump. How weird. I killed the indicator, but it's still drawing. All right, well, I got a solution to this. Doop. Beep. Boom. All right. Yeah, I don't have to go through the objects one by one. But anyways. All right, so here we are in the daily on oil. And I'm looking at this as a bottom. I don't see, there's no reason why oil should be significantly higher, but I don't think there's real reason for oil to be significantly lower than where we are. So like this, I'm thinking we're in a $45 to $65 range, generally speaking, right? I don't have it drawn quite like that, but that's what I'm thinking. For quite some time, like till the end of the year and into part of next year, we'll be in the 45 to 65 range. And again, fundamentally, I just don't think there's a need for it to go down to 35. Too many people lose, right? But if oil breaks above 50, the frackers are going to show up, and within 30 days, move it back below 50, and then they stop again. So above 50, they turn it on. So let's say if prices get up to this area, like 60, frackers turn the spigots on, oil shows up, drops the price. Drops below 50, they turn it all off. Takes a while to burn through that inventory, then pretty soon we're low, and boom, drives the price back up, they turn the spigots on, and we trade it like an oscillator from here on. I have a friend in the oil business, and we were just actually talking about this the other day. That was my outlook, that it could be 12 to 14 months before we break above the 65 level. And even then, what we would move to is a 55 to 75 range. But I said on the high side of that, the frackers are just going to bring it down. So, but they'll be in a better place at least, right? And there will be no shortage of oil for a very long time. Now, the thing to change this is quantitative easing in Europe spurs the economy in Europe, increases demand for products from China. China's economy is stabilized, spurs the demand for natural resources, and gold and oil prices, and more importantly, though, like copper and stuff, and steel and iron ore and coal, all these things turn around, and countries like Australia and Canada start improving, and the price of this oil stabilizes and heads up. But I don't think $100 a barrel. I think maybe 75. So really, I think we're going to be in a 60 to 75 level, but not this year. And the only thing to turn oil prices around is quantitative easing in Europe. Now, you might have caught my conversations in the past about we need it to trickle down to the average yuan. Have you guys heard that speech? I've done it 2 or 3 times here at FX Street, where the ECB money has to get to the average yuan, which will take about 18 months. And then yuan needs to buy crap from China. And then China has to draw down its reserves, and then it needs to go across its borders to buy from other countries, and so on and so forth, and demand goes up. So we're going to need 18 months from now for this to fully take effect. There's my 18-month outlook. And I can tell you 12 months from now, we'll be a lot better off than we are now, but it won't be fully trickled down. So maybe Europe will be in a much better place, but China will just be stabilizing. So now we need 18 months from now for China to stabilize. So 18 months from now, China will be in full force of buying natural resources globally, which would then recover the prices here. So basically, there it is. And I'll show you how I had this marked up in December. Yeah, and I should also, I guess, point this out at the risk of sounding arrogant, but I did predict all of this last year. Last year, we set this up. And it looks like here. So that's what I'm thinking, my friend. The top of this market is the 382 Fibonacci retracement. The bottom is the neckline. I don't think it'll go down much further. I think we're sort of in a buy zone. We're bouncing off the 786 of this move here. So oh, that'll be a good one. I'd love to read that. Now remember, World War I, even though you were taught in school that Archduke Ferdinand was assassinated, so the whole entire world went to war. Does anyone actually believe that? That the entire world went to war because some, Archduke Ferdinand of, I don't know, Spain went to war? I mean, come on. That's what they teach in school. How stupid is that? Like, that dude was that important, right? Sure. Actually, what happened was England converted their coal-fired navy, they were the superpower, right, because of their navy. They converted their navy from coal-fired ships to oil-fired ships because, they're more efficient. Well, and they could get all their oil from their colonies, right? Well, Germany had to then, the second largest superpower, well, they were forced to convert their navy from coal to oil. But the problem is their colonies, the German colonies, didn't have any oil like the English did. So they said, well, if we don't convert, we'll just get slaughtered by the English and we'll lose our superpower status, right? England will take over the world. So they started to negotiate a deal with Iraq, and Germany started building the Berlin to Baghdad Railroad so that they could bring in oil and supply a newly converted oil-fired navy. Well, hell, if England allowed Germany to do that, then they lose all of their technological advantage. Now, does anybody feel like that could create a world war? Two superpowers fighting over a technological advantage? Or do you really think it's some Archduke Ferdinand? So that's what it was. The war was over the Berlin to Baghdad Railroad. World War I was over oil. Germany lost World War II because of oil. The United States entered the war. Uh-oh. So why does Germany attack Russia? Why does Germany surround Stalingrad? Oh my gosh, does Stalingrad have oil? It was all about oil. Why did World War II end? The Germans ran out of oil. Literally, the Battle of the Bulge against America, the German tanks actually stopped in the middle of the fields, just literally ran out of oil and gas. Just, psh, and that's it. The war was over. Or let's say the war was a lot easier to win when Germany doesn't have any airplanes or tanks. So, a lot of that was over oil. Why did World War I start in the desert? Over, Egypt and Libya and Tunisia. Do you think it was possibly oil? Yeah, so it's all about oil, guys. Always has been. Very interesting stuff. So I'd love to read your thesis. Yeah, so only if our schools didn't have confused people teaching, gullible young children, we'd be in a better place. Well, I think we've taken enough time from FX Street and the moderator. So, hey, it was nice to hang with you on this Friday in the middle of summer. I hope you're starting to find some success. I really want the best for you, okay? Well, thanks, guys. And I appreciate your loyalty as well.